Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, one of the managing partners at PassiveInvesting.com. I want to welcome our guest. It's actually a guest again. So he's been on this podcast before. He's coming on to talk about another asset that he's closed. We have Jonathan Barr with us. Welcome to the podcast, Jonathan.
Hey, thanks for having me, Dan.
Awesome. Well, I'm looking forward to diving into this asset called Meridian Place Apartments out of Oklahoma City, 69 units. You closed on this thing just recently in July of 2021. So before we dive into that asset, share with the listeners that maybe didn't hear your prior story or in your prior episode, share with the listeners a little bit about your background and then how does it relate to multifamily?
Sure. So grew up in a real estate family, joined the family business after the last recession where we're doing flips, did about 400 flips in that 10-year period. Did some ground up construction, and this is all in Los Angeles, had a small portfolio of smaller multifamily in Los Angeles that I've now been selling and 1031ing into properties in the Midwest. So we have a building in Kansas City and now we have 2 in Oklahoma City, and we're continuing to grow that. And some of that being our money and a lot of it now starting to be more other people's funds.
That's awesome. That's great.
Yeah.
Well, let's go ahead and dive into this asset and let's talk about how did you find it?
So yeah, this is a actually interesting story. So I'm active on Twitter. That's kind of my social medium of where I'm pretty active. And a lender that I met through there connected me to the broker that had just talked to the seller and brought it to me first, or I believe one of the first ones. And it was actually a pretty lengthy negotiation. We put it under contract in January of 2020. We fell out because the seller had misrepresented the size of the units and wouldn't give us a discount. But then 3 months later, he did give us a discount. We got a better rate from our bank. And we were able to do it with a little less staffing. So we were able to make it work at the new price. But so we started that negotiation in October of 2020 and then closed in July of 2021. So it was a fun one.
Yeah, no. Well,
yeah.
it definitely, every store that we have on here, it's always just a little bit different on how people, locate and they find these deals and things like that. That's definitely a unique way that somebody has found a deal. So that's great.
Yeah.
Well, talk to us a little bit about the offer process that you did with this particular acquisition, as far as submitting the offers and going back and forth and, any earnest money deposit, things like that.
Yeah. So we bought it from the original builder. So he built 4 of the buildings in the 80s, 1 building in the 90s, and 1 in 2012, and he managed it himself. So the beauty of it was he doesn't market anything online. So just the fact of us marketing online is going to make a big difference. Doesn't have any software, had way too much staff on there. But as the thing about mom and pop sellers, though, is they can be really tough negotiators, I've noticed. And there was just like a lot of back and forth and just like weird things that he wanted that honestly weren't even that big of a deal to us. And so and then those certain things like how things were prorated at the end. So there was a lot of back and forth because of that. And then like there was a weekend, we actually had to pay significantly more because there was like a Thanksgiving, he was with family and his son's like, no, you can get more. And then you talk to a CPA and it was a dramatic negotiation, to be honest. Eventually we settled everything. And the interesting part about it is he got a lot easier after I actually met him in person. And I like to look up sellers when I'm interacting with them. I found out he was an author. So I looked up his book. I didn't read the books, but I kind of got a gist of it. And I talked to him about it. And after we had like a good conversation, we were face to face with each other. Everything got a lot easier after that.
That's an important key point that you just mentioned there about knowing the seller, right? Kind of, and it's nowadays with the internet, it was really easy to look people up and, research them. And it's
found them on Facebook and went down that path,
Oh yeah. No, that's great. That's great. And I'm sure you probably were able to build some good rapport with them that way too.
Yeah. It was a lot better after that. You put the human face to it and you're just not just a name on a page.
So what was the kind of final arrangement or agreement on the purchase price that you ended up getting under contract?
$3.5 million. And then a $50K credit for the windows that we're not changing all the windows, but a good chunk of the windows we're changing out. And we did a credit instead of price reduction because it just kind of made more sense for the deal that way. And the seller was okay with that.
Sure. Now, in this negotiation, was there any seller financing, or was it all just free and clear and bank
loan
debt plus okay. All right.
Yep.
So got it for 3.5 million, and any hard money or any earnest money deposit?
No regular contingency period, which is kind of rare these days. Everything's like hard money. But it was mom and pop. We didn't have competition on the deal, so we were able to kind of negotiate more terms that were preferable to us.
Did you have to put up any money up front?
A deposit? Yeah.
So what was
50K.
that? 50K. Okay.
Yeah.
So 50K at the start of the transaction.
Yep.
A little over 1%, just under 2%, not too bad.
Yep.
And let's see. And then walk us through the terms of the contract. Was it 30 days due diligence, 30 days to close, and some extensions built in?
30 days physical, 45 days financing, 60 days to close, and then a 30-day extension if we needed it with a 1% additional deposit.
Okay. All right.
Yeah. Pretty simple.
Yep. So 30, 45, 60, and then additional 30 if you need it.
Yep.
Okay. Good.
So up to 90 days, but I mean, we closed it in, I think, less than 60 days.
Okay. That's good. So how long did those negotiations go on if you closed it that quickly and you closed it in July? So you started in the fall of 2020, and then
the initial contract, we went under contract in January of 2020. So it was about 3 months of negotiations, and then we fell out of contract because of the size of the units issue, and we were out of contract for about 3 months. And then we went back to him. He finally gave us a reduction. We got a better rate from our lender. And we got a better rate because we have large deposits with the bank, and they give us better pricing. And then our property manager was taking over another smaller property nearby that we could share the PM with. So we were able to get a little less payroll because of that.
Good.
Yep. So to kind of the combination of those things kind of made it work.
Sure. No, that's great. So now got it under contract. We're in the due diligence process.
Yep.
Any issues come up during due diligence?
Let me think.
Financial or physical?
Not really. The only annoying thing was we originally had paid for an appraisal on the first transaction, and that appraisal company wanted to charge us again for the appraisal, even though we had already paid for it. So we had to go with another appraiser because of that. But the bank ended up crediting us some money to make up for that a bit. But that was like one big annoyance.
That can definitely be annoying. Now, one of the things that we always see with, I don't say always, we typically see with a kind of smaller mom and pop operator or seller is that a lot of times the books aren't kept up very well. How were the books on this property?
Not kept up very well. But we already kind of knew that because we had seen everything before.
Yeah.
But yeah, like delinquency reports everything was by hand, like the rent ledgers were by hand. So our property manager actually had to go to the owner's office and scan every document, every lease, all the financial information. We kind of had to interview things because things weren't clear. So we're like, what about this person? This isn't clear. So there was a lot of like due diligence and figuring out. And honestly, after the fact that we've had to kind of clean up some of that stuff now in ownership.
And you're making everything electronic now, right?
Yeah. Everything. We use Yardi. Everything's professional, but yeah, it's been a little bit of a challenge now on takeover, just making sure we know who's who paid when, who has what deposit, all that kind of stuff has been kind of a little bit of a, I want to say disaster, but we've had to figure out a few things after the fact.
Now, when you did your unit walks, obviously you're going to look at all the leases, make sure that they're in place. Is that something that you guys physically did, or was that mainly just the lender that came in and did that?
No, we do that.
Okay.
Along with our PM. So we had like a Google sheet with all the information, and we had all the paper
were the leases
documents
pretty much in order?
They were all kind of They were in order, but some didn't have deposits, some did have deposits, some leases were a little bit different than others, but he was actually like somewhat organized, I'd say.
Mm-hmm. He was organized for him, right?
For him, it worked for him. For us, it was like trying to figure some things out, but I've seen worse things than this seller for sure.
So it wasn't the worst one you've dealt with.
Yeah, exactly.
All right, good. Well, walk us through the financing on this one as far as the debt is concerned.
Yeah, so we use Bank of the West was the bank we used. They gave us the rate was 2.52 30-year AM. And the reason why they gave us that pricing is they had a promotion, and also we kept large deposits. So we kept 25% of the loan in deposits with them to get that rate. And actually one of our investors also deposit some money with the bank to help us hit that mark.
That's good. And so it's any interest only?
No interest only, but at that low of a rate, it kind of doesn't matter.
Sure. No interest only, 30-year, 2.52.
Recourse. Yeah.
Say again?
It's recourse too.
Yeah, full recourse. And what's the balloon?
5 years.
Okay.
Yeah.
So 5-year balloon.
But our idea is we're going to refinance within 5 years into agency.
Okay. So walk us through the business plan on this deal. What's the kind of the overall kind of plan to take it from the 3.5 million to the next level up?
Yeah. So we're going to do modest rent bumps, probably about $50 across the board. We're changing out windows. The biggest thing is just cutting expenses with less payroll, and some other miscellaneous items that we're doing there, and just kind of running it a lot better than it was being run before. But the idea is within 3-4 years, refinance, hold longer term from there, return at least 60 to 70% of the money. And yeah, keep it going. And the thing about it, it's in great shape. Just the 80s building needs new windows. So we're doing new windows, no rebranding, anything like that. The office that was used as an office, we're turning that, and it's actually done already. We're turning that into a rentable unit again. And then we found another area to put an office in. And we're going to have a part-time PM there that is in that office and is kind of bouncing back between another property nearby. But yeah, like the good thing about having the original builder and having a mom and pop that kept it in really good shape is, and that the fact that it is a little newer, is the work orders comparing to our 1970 building is a lot less than what we're dealing with over there. So maintenance has been pretty easy so far.
And I had a question for you on the CapEx. Is there any renovations being done inside, or is it just the windows right now?
Just the windows, but we do have some money set aside for any like heavier turns, because the other benefit about this property was that the average life of a tenant there is 4 years, which is really good for multifamily, as you would know. And he actually did pretty good with rents, even though there's still a little bit of room there. But yeah, so we do have some money set aside for that. Okay.
And speaking of the lifespan of the residents there, what's the or all of the residents on long-term leases, or were some of them on month to month? So you can actually,
they're all on month to month.
They're all month to month. Okay. That's even better.
Yeah. It's so we're not going to renew everyone right away, just because we don't want to increase rent for everyone and then everyone leaves. So we're doing, a good handful every month, and kind of starting with some of the bigger increases first, or starting with we're doing like a mix of people where like they've also came up to us and asked about renewals and if we're going to raise rent. So we're starting out with some of the people that have been more communicative first, and then kind of work our way down the list over a year span.
What's the average effective rent for the property?
When we bought it, it was $641.
And what's the average market rate?
It's probably, let's see, about 660, 670, somewhere like that. But over a couple of years, we'll move it about $50. And we're also implementing RUBS.
Okay, good. So it's not too far off from where the market rate is right now.
No.
Okay. So that's why you were saying he still maintained that. And for the listeners here, I want to make sure I clarify something. When I said good to the month-to-month leases, it doesn't mean that I like month-to-month leases on my property, right? It just means that when you're buying a property, if everybody's on month-to-month, it gives you a lot more options to be able to set renewals and flexibility to increase the rent and stuff like that. So,
or non-renewal if you don't want to keep them.
That's true too. That's true too. That's definitely a good thing. So having those all on month to month, I think is a good thing. One of the strategies, just so you know, Jonathan, and maybe you've already thought about this, is raising the rents a little bit higher than the market rate. And basically saying, going to the residents and saying, so like right now, let's say they're paying $600 a month. You can say, we're going to be increasing your rate, or the rate's going to be increasing month to month to $700 a month. However, if you want to sign a longer term lease, say 12 months, then you can get it for $675 or $650 or whatever. That way you're giving them the incentive to actually sign the longer term lease instead of getting the higher rate.
Yep.
So
the other thing we're doing is we're implementing a security deposit insurance, Rhino, if you've heard of them.
Yep.
So we're going to return to them their deposit if they sign up for that. And the reason why we do that in Oklahoma is because deposits are so low that with Rhino, they'll cover more stuff, or we give them the option of doing a full month's rent, because right now the deposits are like $200-$300. So if we can get like $600-$700 deposits, or get Rhino, that'll cover $1,000+ more damage or back rent and stuff like that, it actually makes a significant impact.
Sure. No, that's definitely a good idea. I've heard of Rhino and a couple of other services out there that are doing that stuff as well.
And I vetted them with a bunch of owners that I know, and they seem to be doing a really good job. And we talked to them for a while, and I asked a ton of questions, because I'm like, how they make this they're charging $15 a month and they're going to come and cover $1,000. And I guess their thing is like, not everyone uses all the money, and it's like insurance, you know?
Yeah, we've actually looked at creating our own captive accounts. A lot of the larger operators that have, tens of thousands of units or whatever, they'll actually create their own captive insurance policy and underwrite and do those policies themselves.
Oh, really?
Instead of doing the deposits as well. So it's another kind of way to increase the revenue for the property. If you can, not collect not collect the deposit, but basically collect to keep the deposit basically with by breaking it up into monthly payments and stuff too.
Yep.
So obviously you got to have enough money in the captive to be able to manage that and be able to pay out for the policies and stuff like that. But definitely something for as you grow to kind of look into a captive insurance policy, not even just for the resident deposits, but also the resident liability insurance can also be made that way as well, where you're actually
make some revenue there.
Those.
A small spread there.
Yep.
But we learned that on our last deal, we didn't have enough money for turn costs because of that reason, where, their deposit's $300, but they could easily create $1,000 in damage. And then we're on the hook for that. So we ended up having a lot more turn costs that on this one, we're like, we need to change something. We need to make something better. So that's kind of our solution.
Good. Well, how are you structuring this deal, or how did you structure this deal with investors?
So we did a 80-20 split, 1 point for acquisition fee, 1.5 for asset management fee. And then the split changes to 70-30 at the refinance, as long as they've been returned all their money with the cash flow and the capital that's returned to them.
All of the capital, or the 60 to 70% that you mentioned earlier?
The 60 to 70% basically. So how we're doing it is the total amount of the cash flow they receive plus the capital, as long as that's 100% of what they put into the deal, then the split will change. So it could split later, but most likely the way we have it, it'll be at the refinance.
Sure. Okay. That makes sense. So you're calculating the distributions up to that point of the refinance plus the refinance proceeds. And as long as that totals up the 100% of their capital, then the split changes to 70-30.
Yeah. It's a little different, but yeah.
That's
how we designed it.
Yep. No, that's definitely understandable. And any disposition fee or anything like that included in here?
Nope.
No dispo.
Our idea is actually never to dispose of it. Our idea is to hold as long as we can and do other refinances later. Or if the systems deteriorate to a certain point, then yeah, at that point we might sell in 1031 into a newer asset.
Okay. That takes a unique investor set. So
yeah, we have that. And we half the money that we've put into our deal so far has come from ourselves. So we're kind of like directing the ship because of that.
Sure. How much money did you end up raising on this one?
$1,140,000, 25% of it came from us. So we ended up raising like 900 from other people.
Okay. And how many investors was that of the 900?
12. So about 80,000 average across the board.
Okay. And what was the minimum investment?
50.
So 50.
So a lot of people end up doing the 50, right? Especially
if
it's the first time.
Most people always do the minimum.
And
there's usually a couple that will come in a little bit higher, which is probably what balanced out the 80,000 average. So.
Yeah. We had one that did a few hundred. So that kind of brought that average up.
Yep. Not a problem.
Yep.
And can you think of any other issues that came up during this entire process, whether it be due diligence or finance or raising the capital or anything like that, that might be interesting for us to uncover and talk about?
I would say, I think we could have got our manager like more involved on onboarding sooner, because we're dealing with more issues after the fact because of the records weren't kept up as much. So I feel like if we could have found a way to even have some sort of contact with the tenants even before we close. I know that's not usual, but in these cases where records are really bad, just to make sure all the records are completely accounted for even before we close, I think that would have made a difference instead of so like figure it out when someone else is paying for it, not yourself, basically.
You brought up the property management. I actually had a note here to ask you something about this. Talk to me about how the property management is working on this, because I know you mentioned the part-time on-site. They're also working, part-time with another asset. Is it another asset of yours, or is it another property that's not associated with yours?
Another property that's not associated with it. At first, it was with another property that we do own, but the other property that's in Norman was just too far away for our manager to keep on going back and forth, because as you know, things always come up. So someone needs to be close to run over if needed to do a showing or whatever, let a vendor in, whatever needs to happen. So basically how they split it is they just take the total amount of the units and kind of divide it accordingly, depending on the unit. So kind of prorate it. So if we have 69 and someone only has 50, we'll pay a little bit more than that other property. For example.
Okay. Yeah. And how has that worked so far? I know it's only been a few months, but curious to know how it's worked.
It's been a little bit more challenging at takeover to do that, I would say. But once we get fully everything figured out and everything's stabilized and running the way it is, it shouldn't be a problem. We'll have a full-time maintenance person there as well that can take care of some things if needed.
So the maintenance person is actually full-time on your property only?
We don't have one yet, but
you're working
eventually they will be. Yes.
Okay. So what are you doing right now for maintenance? They're just using like third-party subcontractors and stuff like that?
Some third party, and then bouncing some people around from other properties.
Okay.
At the time. But like I said, we barely had work orders on the properties. So it's actually worked out all right.
Yeah. Well, that's definitely good, especially when you first take it over, not have to worry about the maintenance side too much.
Yeah. There's been like 1 or 2 work orders a week, which is nothing on a property like that.
That's great.
Yeah.
Well, I got 2 final questions for you as we wrap it up. Same final 2 as last episode we did together.
Yep.
First one's going to be, what did you find that was easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
Actually raising capital was a little easier this time, because the first one we basically kind of missed the mark and had to bring up most of the money ourselves, which luckily we had and we're able to do. But this time I learned from the last time that, because before we had just spoke to our inner network, and finally we kind of like, I got on social media, I started having an email list, I started putting out content, a lot of stuff that you do, and it actually works. And we raised a lot of money from people that we had never known before. Then we started to build a relationship over months of creating content and being in communication, having calls and doing all that stuff.
Final question for you is the opposite of that. What did you find was harder than you had originally expected?
I think mom and pop owners are great because usually you can get a better deal that way, but they're much more stubborn and difficult to deal with and have not the best records. So that part was a lot harder than I imagined. But now I'm more prepared for a situation like that. But that's where the opportunity is too. That's part of how the opportunity is created.
No, definitely for sure. Now,
but it's a pain in the butt is what I'm trying to say.
Oh yeah. Now you obviously bought it for the 3.5 in 3 to 4, maybe 5 years. You had kind of mentioned doing a refinance. What's the projected refinance valuation that you're looking to do?
Probably it would be somewhere around the 5 million mark, I'd say.
Okay. Yep.
Yeah.
So right at the 5 million.
I have those numbers. I should have pulled that up. But yeah.
I just pulled that one out of my hat right here at the last
Yeah.
one, just to throw you for a loop there, Jonathan.
Yeah.
Sorry about that.
It's all good.
Well,
got to be on my toes, right? Keep me on my toes.
That's right.
Yeah.
Especially when I'm the one asking the questions, right?
Yep.
Well, I want to thank you for being here and participating with the podcast once again. Looking forward to continuing to follow you as you close more deals. How can the listeners reach out to you if they have further questions for you about this acquisition, or maybe they just want to continue to follow you more?
Yeah, you can follow me on Twitter at JB2 Investments or go to our website, jb2investments.com. I also have an ebook on there about accelerated depreciation, 1031 exchanges, and investing with retirement funds. And it's just jb2investments.com/lower.
Awesome. Well, again, thank you so much, Jonathan, for being on here. I really appreciate all this, and looking forward to having you on a future episode as you continue to close more.
Yeah, thank you.
Awesome. Thank you so much, Jonathan.
Yeah, thanks.